So I'll be covering the 3 things that every investor needs to be doing before they start investing. And I don't really want to be lecturing you guys here, but this is some basic information and I think it's good for everybody, but it is more catered to those that are going to be investing more in the stock market, more money. If you're investing just a little bit, some of this advice isn't really that big of a deal, but it still can apply to you. So just hang tight and I'll explain what's going on. Because if you're only investing like $100 into the stock market and you lose it all, then it's really not that big of a deal. It's probably not going to affect your entire life just because it's a little bit of money. But if you invest a lot of money and you're not doing it correctly, then some of this advice is probably going to be good for you because you don't want to go into the stock market when you're doing things in a backward order. Okay, so the first thing that you need to do before you start investing in an individual account is that you need to take full advantage of all the tax savings accounts that are out there, the tax sheltered accounts like Roth IRAs, 401ks at work, or maybe a SEP if you're self-employed. You need to take care of those first before you start investing because you might as well take care of all the tax savings that's available to you through the government. So definitely make sure you do this first. And I do realize that I'm talking about investing in 2 separate categories here. I'm talking about investing for your retirement with all the tax sheltered accounts that are available to you. And then I'm also talking about just an individual account that's a normal taxable account, because the difference here is long-term capital gains. You can pay up to 20% in just an individual account. Whereas if you're doing the tax savings sheltered accounts like a Roth IRA, 401k, those are going to help you a lot better as far as tax savings go for your retirement in the future. And you want to max those out before you start working on your individual account. So for instance, if a Roth IRA has a max of $6,000 a year, then you want to max that out at $6,000 and then move on to your individual account so that you're maximizing everything that you can in terms of taxes. And also, if your company offers any sort of a 401k match, I would do whatever you can to take full advantage of it because it's always going to be worth your effort. Because for example, if your company offered a 5% match and then you also contributed 5%, then that is just instant free money that you're going to be getting that you can't even get in the stock market because it's 100% return and it's almost instant. Because if you did put in, let's say $200 and then they also match $200, then that is just instant money that you're getting, doubling your money. And that's all because of the 401k match because you're taking advantage of it. So just make sure that you max out all of the tax sheltered accounts that you can, and then also max out your 401k match before you start investing individually in the stock market. And this is the right order that you should be going in. Now, if you guys do have any questions and you need to talk to someone that's professional, I'm just some guy on the internet, so take this advice for entertainment purposes only, but seek a financial advisor if you guys need to seek further help on this kind of stuff, because it does get fairly complicated and there is help out there for you. Now, the next thing you need to do before you start investing in the stock market is that you absolutely need to pay off your high interest debt first before you start investing. So if you've got credit card debt, personal loans, anything with really high interest payments, you need to pay those off first before you start investing because that's the right order that you need to be doing. Because if you actually go back to 1926 when the S&P 500 first started, their returns have averaged about 8 to 10% through all of the years, through all of the ups and the downs. And so if you've got a credit card that's actually at 18% and you get a return of 10% in the stock market, then you're still going to be losing 8%. And so that's never going to get you ahead. You have to take care of your high interest debt first, meaning your credit card at 18%, so that you can actually start making money in the stock market. Now, if you do happen to have high interest debt at home, but you've got a retirement account going on, like let's say you have a work account, a 401k, or even a match, I do still want you to take advantage of that kind of stuff, even if you have the high interest debt. It's not fully advised, but I think this is still a good idea to have that compound interest working for you for all of those years. Do take care of your high interest debt as soon as you can, but keep those retirement accounts going. I'm just referring if you want to do an individual account, like you just want to hop on Robinhood and start investing, definitely take care of that high interest debt first. Now, the last thing to do before you start investing in the stock market is that you should only be using money that you can afford to lose. Because let's say you invest $5,000 into the stock market and you lost it all, you don't want that to be your emergency money or some type of savings that you have, because that's money that you don't want to be losing. Because if you needed the money tomorrow and you sold all of your shares, you always have to wait a couple trading days just for that money to settle. And then on top of that, the money still needs to settle through your bank. So a lot of the time it can take about 4 to 6 business days just to get the money. And that's assuming that the stock prices are where you actually want to be selling them. Because if you bought all the shares for $100 and then the share price went down to 50 right when you needed to sell them all because there was an emergency, then you're going to have to sell them at a loss. And that's something that you might not want to do if you would have just had a regular emergency fund and you weren't investing with that money. Now, obviously, life happens, and sometimes even if you do have an emergency account, you might have to use all of that money and then sell some shares just because you don't have a choice. All I'm saying here is that you need to be prepared. So if you take care of your emergency fund and you also make sure that you have a proper savings account, you want those to be as liquid as possible and don't have those tied up in the stock market. Because if you need the money today, you need to be able to go to the bank and get that money, and you don't want to have to wait and sell those shares at possibly a loss, which is something you really don't want to be doing. So just remember to always take advantage of all of the tax sheltered accounts that are available to you. Make sure that you pay off all your high interest debt and then only put in money into the stock market that you can afford to lose. And then also make sure that your savings account, your emergency fund, aren't tied up in the stock market so that you can get your money easily. Now, if you take care of those things first, what you're doing is you're prioritizing other things before you start investing in the stock market so that you can have better results down the road. Because at the end of the day, you want to make as much money as possible. And these are some tips that you can use to make sure that that happens.